Money, it controls our decisions, shapes our lifestyle, and determines our future. But what if you could control it instead? Welcome to this complete guide on mastering personal finance. By the end of this video, you'll have a clear strategy to build wealth, eliminate debt, and secure your financial future. Let's start with the basics, budgeting. Your budget is your financial blueprint. Without it, you're sailing without a map. A budget gives you control over where your money goes and helps prevent financial stress. Follow the 50-30-20 rule. It's simple but effective. 50% of your income should go to needs, things you absolutely cannot avoid, like rent, utilities, groceries, and insurance. 30% is for wants. These are things that improve your lifestyle but are not necessary, like dining out, entertainment, or shopping. The last 20% goes towards savings and investments. This is the portion that secures your future. If possible, aim to increase your savings rate over time. Tracking your spending is key. Every rupee you spend should have a purpose. Use budgeting apps, spreadsheets, or even a simple notebook. The goal is to understand your spending habits and adjust them to align with your financial goals. Next, let's talk about an important enemy. Debt can either be a tool or a trap. Good debt helps you grow, like a home loan, student loan, or business loan. These investments usually increase in value over time. Bad debt, on the other hand, drains your wealth. Credit card debt, high-interest personal loans, and unnecessary borrowing should be avoided as much as possible. If you're struggling with debt, prioritize paying off high-interest loans first. The debt snowball method can help. Start with the smallest debt, pay it off, and then use that momentum to tackle larger debts. Also, avoid borrowing money for things that don't generate income. Financing a luxury car or taking out loans for vacations can trap you in a cycle of debt. Now, let's move to the most powerful wealth-building tool, investing. Saving money alone won't make you rich. Investing will. Inflation reduces the value of money over time, so if you're only saving, you're actually losing purchasing power. The earlier you start investing, the better. Thanks to the power of compounding, even small investments can grow into a fortune over time. For example, if you invest just $5,000 per month in an index fund with an average return of 12% annually, in 20 years, you'll have over 50 lakh. Start with safe options like index funds, exchange-traded funds, ETFs, and blue-chip stocks. If you have a higher risk tolerance, explore sectors with strong growth potential. Diversification is key. Spread your investments across multiple asset classes, stocks, mutual funds, fixed deposits, real estate, and even gold. Avoid get-rich-quick schemes. If it sounds too good to be true, it probably is. Invest wisely, think long-term, and never put all your money into one investment. Emergency funds. Do you have one? Life is unpredictable. An emergency fund acts as a financial cushion for unexpected situations like job loss, medical expenses, or urgent home repairs. Experts recommend saving at least 3 to 6 months' worth of living expenses in an account that is easily accessible, like a high-yield savings account or a liquid mutual fund. Remember, this fund is only for real emergencies, not for vacations, shopping, or impulse purchases. Now, let's talk about a critical topic, retirement planning. Retirement may seem far away, but the earlier you start, the better. The goal is to ensure that you have enough money to maintain your lifestyle when you stop working. Start by investing in retirement plans like the Employees Provident Fund, EPF, Public Provident Fund, PPF, or National Pension System, NPS. Take advantage of employer contributions to retirement funds, if available. These contributions can significantly boost your retirement savings over time. If you're self-employed, consider setting up an SIP in mutual funds or other long-term investments that can support you later in life. Your future self will thank you for the choices you make today. Let's move to an essential habit, smart spending. Every rupee saved is a rupee earned. Practicing mindful spending ensures that you get the most value for your money. Always distinguish between needs and wants. Before making a purchase, ask yourself, do I really need this? Will it add long-term value to my life? Try to live below your means. Just because you can afford something doesn't mean you should buy it. Use cashback offers, discount codes, and reward points wisely. However, don't overspend just to take advantage of these benefits. Impulse buying is a silent wealth killer. A simple trick is to follow the 24-hour rule. Wait a day before making non-essential purchases. This helps reduce unnecessary spending. Now, let's talk about something we all avoid: taxes. Paying taxes is mandatory, but smart tax planning can help you save money legally. Make use of tax-saving investment options like equity-linked savings schemes, public provident fund, and tax-saving fixed deposits. Understand deductions available under Section 80C and other tax benefits that can reduce your taxable income. Also, if you're an investor, learn about capital gains tax and how to optimize your tax liabilities on stock market profits. Lastly, financial literacy. Your best investment is in yourself. The more you know about money, the better financial decisions you'll make. Read books on personal finance, follow financial news, and watch educational videos. Surround yourself with people who have a wealth-building mindset. The people you spend time with influence your financial habits more than you realize. Your financial future is in your hands. Start today. Small changes will lead to massive results over time. If you found this video valuable, make sure to like, share, and subscribe for more financial wisdom. Your journey to financial freedom starts now.